All right, guys, the biggest news yesterday was the Oracle quarter. Now, last fall, to take you back, something strange happened. Credit default swaps on Oracle blew out, and the credit market was looking at the $50 billion in CapEx commitments and negative free cash flow that Oracle was talking about, and said this company is over leveraged. Sell the risk. Everybody started to pay attention to these CDS spreads on Oracle. The credit market was measuring the right thing, but it was measuring the wrong signal. So I went back and I did something that most investors never do. I read through 6 consecutive Oracle earnings transcripts. So that covered 18 months, 6 transcripts. It was the same company, same stock, same Larry Ellison, but completely different management behaviors across the arc of those calls. So in the first 4 quarters, only 2 people spoke, Safra Catz and Larry Ellison. And every time analysts asked questions about margins or free cash flow, Safra used the same phrase: we remain careful to pace and align our CapEx. Every quarter, those words appeared. So it was the same hedge, same language. And the numbers were improving, but the language wasn't. So that in itself is a signal. When the numbers improve, but management language doesn't, the conviction is capped. So you don't add to positions at that time. So then something did change under the arc, and Oracle's leadership team got restructured. So there were 2 new CEOs, remember, 2 finance leadership, so 4 voices instead of 2 on the calls. And suddenly the language with all those new people transformed. So Clay McGurk started giving exact margin ranges: 30 to 40% on GPUs, 60 to 80% on database. That had never been disclosed before in the prior calls. And another executive started naming competitors directly: Salesforce, Workday, SAP, by name. And then Oracle explained the BYOC model, customers funding the infrastructure. So that eliminated the free cash flow problem overnight. So 3 constraints dissolved at once: the financing, the transparency, and the execution. So that's not improvement, that's a regime shift in the management behavior itself. So from a Rising Dynasty perspective, here's the rule. First, the management language changes on these calls, and then the operational architecture changes, and then finally the financials improve, and then after that, only after that, the credit spreads tighten, and then the stock reprices. So most investors react at step 4, but the language shift, that's at step 1. So numbers can always be engineered on these kinds of calls, but the language across 6 quarters can't be easily engineered. And there aren't PR firms to do it either. Structure always speaks first. That's day 204.